The 1997 Asian financial crisis wreaked havoc in mainly 5 countries: Indonesia, Korea, Malaysia, the Philippines, and Thailand. If you were back then an individual investor exposed to any of these stocks, bonds, or real estate, you took very heavy losses. Do you invest in emerging markets today? The lessons of the 1997 Asian financial crisis are relevant to you, lest you get caught offsides when the next crisis hits. Let's start with the onset to 1997. Radlett and co-authors write about the region's long track record of economic success. Asian economies boomed. In Malaysia, Indonesia, and Thailand, per capita income more than quadrupled from 1965 and 1996. In Korea, income rose 7-fold. The model for East Asia's industrial success was to integrate with international production, attracting export-oriented foreign investment. And it worked. The benefits of economic growth were also widely shared throughout the population, as poverty fell. Radlett and colleagues continue. In the 1990s, there was a rapid buildup of short-term external debt into the booming East Asian countries. The annual capital inflows into the economies of Indonesia, Korea, Malaysia, the Philippines, and Thailand averaged over 6% of GDP from 1990 to 1996. But these Asian governments maintained exchange rates with either very little variation, such as Malaysia, or small, predictable changes, such as Korea. Domestic bank lending boomed in the region. Much of the new lending was financed by the banks borrowing offshore. In Korea, the foreign liabilities of the banking system more than doubled to 10% of GDP in mid-1997. But exchange rates appreciated in real terms, as the capital inflows put upward pressure on local prices. Local currencies became overvalued. And thus, export growth slowed in the mid-1990s, and then dropped sharply in 1996 in every country. What would happen if the Asian countries were forced to devalue? Interestingly, the East Asian governments managed their government accounts conservatively in the early 1990s. East Asian governments kept their budgets in surplus, maintained prudent levels of overall money growth, and kept inflation below 10%. In each country, government foreign debt actually declined as a share of GDP during the 1990s. Was that enough to avoid a financial crisis in the private sector? It was not. Radlett and colleagues write that it all started in early 1997 in Korea, where Hanbo Steel declared bankruptcy with around $6 billion in debt. Soon, both Sammy Steel and Kia Motors were next. These bankruptcies put increasing pressures on Korean banks, which had borrowed offshore to lend to the bankrupt manufacturers. Around the same time in Thailand, a major property developer, Samprasong Land, missed a foreign debt payment. Were local banks exposed to the Bangkok property market in trouble? Currency speculators, including famed George Soros, immediately attacked the Thai baht. In March 1997, the Thai government considered to bail out bad property debt, but then reneged. Speculation mounted as foreign exchange reserves dwindled. By late June, Thailand had sharply reduced its liquid foreign exchange reserves, and the Thai baht was finally allowed to float on July 2, 1997. Foreign lenders reacted to the Thai baht devaluation by withdrawing capital, not only from Thailand, but all countries in the region. Exchange rates came under intense pressure. By September, the currencies of Indonesia, Malaysia, the Philippines, and Thailand had fallen by 20% or more. As currencies fell and capital flows reversed, a self-reinforcing spiral led to panic. First, lenders made little effort to distinguish among countries, assuming that if Thailand was in trouble, so were all others. Second, as exchange rates depreciated and the domestic costs of servicing foreign debts rose, foreign lenders did not lend further. Third, unhedged domestic debtors rushed to buy foreign exchange to cover their positions. Fourth, the ratings agencies downgraded countries in the region, triggering further withdrawals by lenders. Morris Goldstein summarizes the damage of the 1997 Asian financial crisis as follows. First, stock markets in the region took major losses. Worst hit in local currency was Korea, with a 50% loss. Contagion spread beyond the 5 Asian countries in the epicenter of the crisis. Note that all losses here are in local currency. If you were an international investor exposed to these stock markets, you have yet to account for the currency depreciation. It was a brutal double whammy. How about the local population in the 5 core countries of the 1997 Asian financial crisis? Did economic hardship follow? All of the 5 focus countries plunged into a recession in 1998. Worst affected was Indonesia, and least affected were the Philippines. The economic impact was limited to 1998, as all countries resumed a growth trajectory in 1999. And a debate followed: what caused this crisis? Riedla and co-authors compare the 1997 Asian financial crisis with other recent emerging market crises, including Latin America in 1929, Mexico in 1982, Turkey in 1984, and Argentina in 1995. All these episodes share these characteristics: sudden shifts in financial flows, culminating with capital flights, unanticipated crises, provoking economic contractions within debtor countries, and losses to foreign investors. But there are also some important differences. The emerging market crises of 1929 and 1982 seem to have been caused by conditions in lending countries, namely rising interest rates. But the 1994-95 crises were different. International financial conditions were stable, leading some economists to attribute these crises to bad policy in debtor countries. Radlett and co-authors disagree, and claim that the 1997 Asian crisis was even more remarkable. Stress in international financial markets was absent. And domestically, none of the Asian countries ran unsound policy. Real exchange rates were only mildly overvalued. Overall debt carrying was not extreme. Yet the crises hit with a vengeance. The conclusion: we should consider a third type of explanation. What caused 1997 was a self-fulfilling prophecy. Once lenders smell blood in the water, they yank capital indiscriminately. Which leads to a famous phrase attributed to Winston Churchill: history is written by the victors. And according to Radlett and friends, financial history is written by the lenders. When a financial crisis hits and debtors default, debtors are forced to take the blame. Lenders ignore their own shortcomings in analyzing creditworthiness. The 1997 Asian financial crisis was no different. The International Monetary Fund assigned blame to the debtor countries. The IMF strategy for the 3 countries hardest hit, Indonesia, Korea, and Thailand, was to overhaul their financial systems. Our verified sources are shown here. Write to us in the comments section if your interpretation is different, or if you'd like to suggest other sources. What are the takeaways for you? As we've seen in and since the first emerging market crisis in 1825, when emerging markets crash, investors take a double whammy. Their investments crash hard in local currency, which itself also crashes hard. If you held equities in Indonesia in June 1997, you saw your stocks crash 40% in local currency, which itself crashed 80%. Your total loss by late 1997 was close to 90%. And, like any other financial crisis, emerging market crises are very hard, if not impossible, to predict. Thank you for watching. If you'd like to see more financial history from verified sources, subscribe to our channel and join our community striving to learn from the misfortunes of others to avoid similar fates.